Hi, everybody. I'm Dinesh Chawla. I'm one of the co-founders of this school community, Cover Your Assets, otherwise known as CYA Community. Excuse me. So today I'm going to talk a little bit about ordinary income taxes. And I want you to understand ordinary income taxes from the point of view of three entities, we'll call them. So individuals, that's you and I, um, grantor trusts and non-grantor trusts. We've explained what irrevocable and revocable living trusts are. Now I'm going to explain the distinction between grantor and non-grantor. Irrevocable and revocable have to do with the grantor's control and their rights over the trust. Um, Grantor versus non-grantor talks about how the trust is going to be taxed, okay, whether it's trust level or individual level for ordinary income. So, first and foremost, before I start anything, I have to say that just because I'm an attorney doesn't mean that everything coming out of my mouth is legal advice that you should take and go run with. Okay. This is basic education, simple knowledge that I'm trying to give to you. We learned this in law school. But this, however, in this case, this is all federal law. So I'm licensed in the state of Michigan and I am allowed to give advice on federal law. But again, this is not the forum for advice. Okay. This is just free fun facts over here. Um, if you want any advice, you can catch me or make an appointment and we can talk through the community and it'll be one of those paid sessions. But outside of that, let's get into the free fun facts here about taxes. So your ordinary income, the IRS defines ordinary income as pretty much everything that you bring in. Okay. So if you work and you bring in money, that's ordinary income. If you gamble and you bring in money, that's ordinary income. Okay. And it's got to be from legal methods. Okay. So if I sell drugs and bring in income, I'm likely not going to get taxed on that because it's an illicit activity. Okay. But anything you do that's legal in nature that you bring in, you're most likely going to get taxed on it. That includes traditional IRAs and 401k distributions. Okay, so if I pull money out of my IRA, there's going to be a distribution there, and I'm going to get taxed on it at my ordinary income tax rates. Okay, so here's how ordinary income tax rates work. The United States has broken their tax rates up into brackets. Okay, so those brackets are based off income ranges. So from the first income range that can fluctuate from year to year depending on how they change things up. But the first income tax bracket is at 10%. Okay, so and everybody's going to pay a certain amount at 10%. Then we have the 12% income bracket. Everybody's going to pay an amount of 12% if you're within that income bracket. Then there's the 22% bracket. Everybody individually is going to pay 22% within that bracket. So that bracket goes from 44,000 to about 95,000. So on any money in between that you've earned, you'll pay 22% on that money. You'll pay 12% on 11 to 44, and you'll pay 10% on 0 to 11,000. Then we get into the 24% tax bracket, the 32% tax bracket, the 35% tax bracket, and the 37% tax bracket. It's all pretty self-explanatory from there. Okay. So if I am making $578,000, then everything between $231,251 and $578,000 is taxed at 35%. Then everything between 182 and 231 is taxed at 32%. Everything between 95 and 182 is taxed at 24%. 44 to 95 is at 22. 11,000 to 44,000 is at 10. I'm sorry, 12, and then 0 to 11,000 is at 10. So that brings our effective tax rate, the tax rate that we actually pay if we're in that 35% tax bracket, it actually winds up being somewhere around 32% because of all of the lower levels, the tiered taxes that you pay. Now, for a grantor trust, all that's saying is that the trust is being taxed as if it were the grantor. So if I'm the grantor of the trust, which you should have watched our estate planning series by now, since this is a tax series, if you watch the estate planning series, then you should understand what a grantor is. So if I'm the grantor of the trust, and let's say I'm making $95,000 a year, and the trust makes an additional 10, that would put us all together up into the 24% tax bracket, and that's where we would be taxed at the 24%. Now, if I have a non-grantor trust, that is a trust that is its own separate entity, if you harken back to the trust series that we did, and you look at that tax trust, the structure that we had for that trust, that is a non-grantor trust, that closed box. Okay. So that's getting taxed against its EIN, which is its own separate identity tax number. And the tax brackets are way less favorable when it comes to ordinary income. So if I have a brokerage, I'm sorry, that's not a good example. If I have a rental property in my irrevocable non-grantor trust, then I can, and that property is developing, rental income, and that's income charged to the trust because it's a trust property. So if I'm charging $1,000 a month in income, then that trust has an income of $12,000 for the year. So that $12,000, as you can see, gets taxed at 35%. Whereas on the individual side, $12,000 was getting taxed first at 10% and then about 1,000 of it at 12%. So the tax implications are way more favorable on ordinary income when it comes to the individual. So what we've done, again, since we're trying to play like the rich kids here, is we're utilizing types of trusts that allow us to be taxed at the individual level, because we're not worried about that $13.5 million that we need to shield from estate taxes, which is why we would develop the non-grantor trust. But we are concerned about asset protection. We are concerned about asset control. We are concerned about asset growth, and we are concerned about asset succession, just like the rich people are. So we scale it down and we look at how do we make all of our trusts grantor trusts so they get taxed at a favorable level while still affording us asset protection. So if you watch the trust series and you watch the paid for, you should know the MCAT trust will take care of all of this for you. So until next time, I'm Dinesh Chawla, and we'll be discussing capital gains taxes next. So pop some popcorn and get ready for some excitement.